think this is the first time I've done a presentation to primarily a management group. I think there's, normally we do presentations to firms and very often to audit committee members. But so it's been a bit of a challenge for me to do that, but hopefully I met your needs. Grant mentioned I work for CPAB. You know, I go to parties and people ask me, you know, who do you work for? And I say CPAB. And they say, okay, well, who's CPAB? And I said, you know, the Canadian Public Accountability Board, don't you know? And they go, no. And so then the next question, they're kind of looking a little bored at this point. The next question is, okay, well, what do you do? And I have to, you know, simplify it a bit. And I say, well, in a nutshell, we're the auditors of public companies. And that's usually when they go get another drink and take off. So if you stick around and chat with me later, it'd be much appreciated if we get lonely. So here's our agenda. Basically what I want to do is, my goal today is to tell you who we are, what we do, and why that might matter to you as management. Obviously it matters very much to Grant and the firms. We regulate them directly, but what I'd like to do is maybe suggest to you some of these management considerations at the end, why it might matter to management and reporting issuers. Here's our vision statement: to contribute to public confidence in the integrity of financial reporting of reporting issuers in Canada by effective regulation and promoting quality independent auditing. So I just want to go back to the early 2000s and why CPAB was formed. I think you'll all remember in the US they had some massive audit failures due to accounting fraud, WorldCom, Enron, and as a result there was a Sarbanes-Oxley legislation, and the PCAB was created, which is the Public Company Accounting Oversight Board in the US, and they're our American cousins, they're the same. And the big part, the issue is that the industry or the audit firms were self-regulating. The profession was self-regulating. So what came out of Sarbanes-Oxley was an independent audit regulator. And that's what we did in Canada. The CICA got together with the Canadian Securities Administrators and OSFI and created CPAB as an independent audit regulator. And you might ask the question is, well, how do we get paid, right? And well, the answer is you pay us, or your shareholders pay us. Every audit fee for audit services performed by a registered firm in Canada, there's a fee tacked on at 2% that goes to us, which in total, our overheads are about $16 million a year. So that's the cost of independent audit regulation. I think it might be helpful to say what we don't do. We don't set accounting and auditing standards. That's done by CPA Canada. There's the Accounting Standards Board and the Audit and Insurance Standards Board who do that. This is different than the US. If you look at a US audit report, it said it's conducted in accordance with PCAB auditing standards. That's not what we do. We don't regulate the CPAs, and we don't look at non-reporting issuer audits. So a private company, we don't look at those audits. We only look at the part of Davidson that relates to public company audits. So CPABC and the other provincial institutes across Canada, that's their job. That's not our job. Now we have an MOU with them. We share information, and they rely a certain extent on the work we do. We don't want duplication of effort. So what they rely on, they have full access to all our inspection reports and our inspection findings. We don't regulate RIs directly. All we do is look at audited financial statements, and we deal with the firms. That's Carla Marie's job, and she's mentioned, you know, our relationship. And we talk a lot on the phone, and I don't think there's any appetite for the public for something falling through the cracks in regulation. So we have some formal, you know, we have a formal recognition order and 52108, but we also engage in a lot of informal discussions just about things we're seeing, and that's very helpful to us. And the Venture Exchange also regulates the actual reporting issuers. So, you know, we got 40 people in Toronto, 6 in Montreal, and 7 here in Vancouver. And we in Vancouver are the leaders in mining and oil and gas across the country because the resource sector is primarily based out of Western Canada, obviously oil and gas in Calgary. Now you might ask, why don't we have an office in Calgary? And that was my first question, because there's so many head offices in Calgary, and I lived there 8 years. And the reason is really those are mainly audited by the big 4 firms, and we inspect those out of Toronto. Those big 4 firms are headquartered in Toronto. So in terms of the relationship, at the top we've got the board of directors and the audit committee. On the bottom right we have management, and then over the left we have the external auditors, Davidson. That's the audit environment, with the audit committee a subset of the board of directors. We like to look at that and call that the 3-legged stool of financial reporting. And every leg on those stool has to do their job to have good quality financial reporting. So where are we? Well, we're kind of over in the corner there like Haley's Comet coming around inspecting these external auditors. And that's our only direct relationship. So there's no relationship with management. And with the board of directors, there is a dotted line relationship that was created a couple of years ago through a protocol we had with the firms, a voluntary protocol, whereby the firms would report directly some of our audit findings or inspection findings if we looked at a file. And I'll go into more detail about that. The other part of that is the audit firms agreed to send our public reports, which I'll go into also, to the audit committees of reporting issuers, to all of their reporting issuers, not just the ones we've inspected. So just so everybody's clear, we don't deal directly with management. And Carla Marie's mentioned the recognition order. You know, if we tell the auditors go to management and say we think there's a problem with the accounts, and they don't do anything, well, then we have, under the recognition order, we now have the obligation to actually go to Carla Marie. So in terms of what we do, like at the very start of CPAB, all we did was inspections. We looked at audit files, we looked at firms, and we produced reports out of that. Over the years, we've evolved, and you know, the inspection side is kind of a push from the firm side. And where we've got to now is we call it 3 other business lines, in the sense that not only do we do inspections, and that's the bulk of our work, but we also engage in thought leadership, where we take our inspection findings and deal with others, talk to people like academics, deal with the International Federation of Independent Audit Regulators, and we also produce thought leadership pieces on audit quality. We also engage in stakeholder engagement, and that's what I'm doing right now. You guys are stakeholders as management. But you know, our big push there has been with audit committee members, and we're trying to get a demand pull from audit committee members. So we're not just pushing the firms, we're getting the audit committee members to be interested in audit quality and to go through an assessment of the audit quality in how they pick auditors, how they remunerate them, how the audit's planned, et cetera. Now that's a challenge for the smaller reporting issuers, we know that. But for the big reporting issuers, I mean, they are very interested in that. And a lot of the audit committee members and audit committee chairs are ex-partners of CA firms. So, you know, they understand and are interested. Finally, surrounding it all is risk management, and that's we're always on the lookout for what's new in risk. Like many years ago, the Chinese reporting issuers were a risk in the US, and then that happened the same in Canada. And so, you know, we don't want to get blindsided by something like that again. So our antennae are definitely focused. So in terms of inspections, there's 8,000 reporting issuers in Canada. A lot of those are funds. A number of them are debt issuers or not equity issuers. There's 3,600 companies on the TMX and the TSXV. And there's 300 audit firms, but there's only 15 firms that have more than 100 reporting issuers. Davidson is one of them. And we look at those firms annually, and the other firms we look at on a cyclical basis. And we go through a risk assessment to determine, for the smaller firms, which firms we want to look at. But for the reporting issuers, which reporting issuers we want to look at. We do a lot of work on risk assessment, trying to pick riskier files. And considering what's going on in the economy today, you know, we're obviously on the lookout for companies that have a big decreases in stock price or other risky areas. We come up with our inspection candidates, and then we go out and do our inspections. And when we do our inspections, we're looking at both the system of quality control, and we're looking at individual reporting issuers' audit files, which could be you as a reporting issuer. And then we have some communications, and the public communications we have, we put out on a no-names basis 2 documents every year. That just reports on the general state of what we found in auditing in our previous year's inspections. So we put out a Big 4 report in October for all the inspections we did last summer on the Big 4 firms. And shortly we will be releasing a all inspections report for the Big 4 plus all the other firms, including Davidson, and that should be coming out in the next little while. So those are public reports that are on no-names basis. Then we have private communications, which I think might be of more interest to you, one aspect of it. We have a firm report that goes to Davidson. That's our inspection findings, plus our major recommendations to improve audit quality. That's a completely private report. Nobody else gets to see that. Only those other people like the PCOB, where we have a relationship with them, if they have SEC, or if they are registered with the PCOB, plus the provincial institutes get to see those also. What was new in the last number of years, as I mentioned this protocol, is when we inspect an audit file and we have significant audit findings, that now report goes from the audit firm Davidson to the audit committee of the reporting issuer. And I'll speak more about that in detail now. So if we pick your file And if we look at your file, we don't audit everything. We're not the auditors of last resort. We pick focus areas and we look at riskier areas of the audit. We always look at one transaction stream in the audit file. If you're a development stage mining or oil and gas company, that would likely be the purchases payables cycle. And that could be in the G&A, or that could be in the cost of mineral properties, right, or somewhere else. And then we pick 1 to 3 other focus areas. So for a mining company, we might look at decommissioning obligations. If there's a component auditor, we might just look at the whole component auditor relationship. And so in total, we usually do about 3 focus areas. And we do a number of other core procedures, particularly in the areas of fraud and materiality and other things. So in terms of reporting, if we have nil findings, what goes to the audit committee is just a report said, we picked your file, here's the focus areas we looked at, and we didn't have any findings. If we have a significant deficiency in the file, and we define that as when there's not enough audit work to cover off the risk of material misstatement, we will document that deficiency, and that will go to the audit committee. And the audit firm, and typically that includes the audit firm's remediation of that deficiency, which could take some time, so we may have a couple of touches with the audit committee. And hopefully as a result of that remediation, most of the time there isn't a restatement, but sometimes there are things that do arise that result in restatements. Where there are restatements, and it could be that the reporting issuer doesn't agree with us on the restatement, or the audit firm may not agree with us on the restatement, and then basically if it's an accounting issue, that gets sent to Carla Marie, and as Grant wisely said, she's the goddess of accounting, so she's the arbiter of those issues. So we pass it on to them. We're not the auditors of the accounting part. So in terms of our activities, and some of our outreach activities, we are meeting. Does everybody know who the ICD is? That's the Institute of Corporate Directors. We've collaborated with them on a number of things, and just recently we've had some meetings across Canada with them and CPA Canada to talk about the new audit report. And I'll go into a little more detail in the next slide. But here in Vancouver, we had over 100 people show up, and a lot of blue chip directors. I did the presentation in Calgary too, and then we had about 150 people in Calgary, 100 in Winnipeg, and about Saskatoon, about 20, as you might expect. So there is some interest, and we are collaborating with other people. We do meet with individual RIs, like big companies invite us into their audit committee meetings. The audit committee chair invites us in, and we'll do presentations on just what we're doing. We had an audit committee roundtable here in Vancouver last June. I invited a number of Vancouver-based audit committee chairs of large producing mining companies. And we had about 10 people show up, and we had a partner of large mining RI, the biggest one here, Goldcorp, and the chair of the audit committee, Goldcorp, and a bunch of, I said about eight or nine other people. And we had a really good discussion around the new audit report, the expanded audit report, and just how it related to the mining industry. We actually did some research in the UK where that requirement's been in for a while. We also provide some guidance and tools, not in relation to so much gas, it's more in relation to the audit committee's function and governance. Some recent communications you might be interested in is, one is the whole area of the comprehensive review of the auditor. And this has come out of the whole independence and mandatory rotation or mandatory tendering. Where we got to in Canada was a solution. The recommendation was there should at least be a comprehensive review of the auditor by the audit committee every 5 years to figure out whether they want to stay with that auditor or not, rather than going into mandatory tendering or to rotation. There's a document, Mining Industry Insights for Audit Committees, that's on our website, and we wrote that here in Vancouver. It's a 3-page docket. If you're an audit committee member of, or even management of a mining company, we said here's the common audit focus areas and things to consider. And the one thing I mentioned earlier is this new auditor reporting standards. We were surprised how many people weren't familiar with it, but there's CPA Canada is coming out with new auditor reporting standards. It's no longer going to be, the proposal is no longer a pass-fail audit opinion. It's going to include a bunch of key audit matters, and those are a number of 4 or 5 significant areas that they looked at. They will be identified in the audit report and what their response was to those areas. And for example, in the mining industry, the number one was, no surprise, impairment of long-lived assets. And that was the UK experience. We looked at the FTSE 300 in the UK. The second one, surprisingly, was income taxes. But these were producing mining companies, international companies, like Rio Tinto and Glencore. So, but this new standard's coming in, and the deadline for responding to it and the invitation to comment was originally Halloween. It was now moved to the end of February, I believe. But this standard's coming in effect next year for large reporting issuers who are on the big board. And for venture issuers, it comes in the year after. That's the proposal. And I just want to make everybody aware of that. Our response was we generally agreed with it for the larger reporting issuers. We agreed with a staged approach. There's issues in relation to the US for SEC registrants. I won't go into those. But probably the most important issue I wanted to highlight for you was the fact that we came out and said we're not so sure on the costs and benefits for small reporting issuers, or whether this would just be boilerplate disclosure and everybody would say the same thing. So we're aware of the cost of regulation. This would add to the cost of regulation. We're not sure of the benefits. So we're out on record. That hasn't actually been posted on our website. I think they're just doing the translation, but it will be there. So we're interested to see how other people respond. And I mentioned earlier those sessions we did with the ICD. The corporate directors are going to respond to this. And Carla Marie was at our presentation here in Vancouver. And I think we were quite surprised for even the bigger reporting issuers how much reluctance there was to move to this reporting model. Okay, I want to switch gears and just talk about BC now. Just the BC reporting issuer audit environment, which the pain is all you guys or what you're feeling. The venture market is down from 72 billion in 2010. Market cap's 23 now. And the financing went from 10 to 3. So we know people are hurting. It's a very difficult environment down there. And it's just gotten worse with the commodity price slump that's happening now. We used to always say at least there was oil and gas, right? When mining was in the dumps, but at least there was oil and gas. Well, there isn't oil and gas anymore doing well. So investors have no risk appetite. They just don't want to invest in risky stuff anymore. My own theory is part of that's demographics. I mean, the baby boomers getting older and they want to move to less risky products, but that's just happening. And the management and the board, obviously, a lot of their compensation was stock-based comp, and it's not there anymore, and there's no cash anymore. So that obviously would have some impacts on internal controls and internal controls of financial reporting and governance for smaller reporting issuers on the venture exchange. In terms of the reporting issuer audit environment, we hear from every audit firm that the fees are down, and everybody's complaining about the guy down the street taking the audit for much less than they had charged. So we're not sure whether it's the hours or rates, because obviously with all this less activity, there's less work to do. But part of it we think could be rates just due to the competition. I mean, firms have a fixed level of investment, and there may be some marginal pricing going on. Well, we know there's some marginal pricing going on. There are independence rules related to not paying your fees. If people don't pay their fees, that's got implications for the auditor, and we do look at that when we come in and do an inspection. So I guess we're concerned a little bit about the audit quality impact of this environment. And, we looked at audit firm turnover, which we think may be a function of fees or something else. It could be service level, but we think it might be fees too. And Anita is here today from the BCS. He just sent me some numbers this morning. And if you look at an annual basis, 12% of RIs in BC change auditors every year. That's a lot. This year and last year, that was the same number. And I would be interested to compare that to, say, 2006 or 2007, the boom years before the credit crisis. So we'll probably do that, Carla Marie. We'll ask you of that. And so we're worried a little bit about reporting issuers migrating to smaller firms who may or may not have the capability to do some more complicated audits. We're always careful to say that every firm can do, a good quality audit. They just have to make sure they go through that self-assessment and have those capabilities. And we call that audit for migration risk. In terms of our current issues and our inspections and things we're looking out for or have seen, which would be consistent, I think, with what I described earlier in terms of the RI environment, what we're seeing is probably an increase in issues related to the evaluation of accounting policies. I mean, we, unlike the Securities Commission, we get into the audit files and we can see what really is there in the file already. They can only see what's in the financial statements, unless they ask for it. But we do inspection, we see it. So we're seeing sometimes that the work around the accounting policies, we think has probably deteriorated a little bit over time. Carla Marie mentioned impairment of long-lived assets. One of the things I think people have had struggled with is just understanding IFRS. I mean, the difference between E&E assets and development and production assets and the different rules. And this is, a very personal comment, but were I CFO again, I would definitely choose an accounting policy where I would expense all my E&E expenditures and wouldn't capitalize them and just take the whole impairment issue off the table and not worry about it, not send the market signals when I have an impairment. And one of the, I'll call it bright line indicators for non-E&E companies for impairment is if their market cap is below their net asset value. And it's in IFRS, IAS 36, or sorry, 37, 36 or 37, I forget. Anyway, it's there. And we do, when we're picking files to look at, we run that metric. So, we might pick that file. So if that's the case in your reporting issue, there's a chance you might get picked. So anyway, my comment was if I was CFO again, I might consider just taking an expense policy and including a statement at the back of the financial statements on my cumulative, since inception, expenditures. The judgments around impairment indicators, we think people sometimes are just saying, well, they're not coming to the right conclusion. I think in this environment, and you look at some of the viewpoints that have come out, the commodity price decreases, the increases in the cost of capital, the decrease in the market caps, I think just about everybody's probably in some kind of impairment territory and should be looking at. The other issue we see is in relation to the recoverable amounts determination, and Carla Marie mentioned it. And this is when you get into a discounted cash flow for either a value in use or a discount or a fair value less cost of disposal. There is some confusion in the mining companies whether what the basis for that determination, and people are looking to the economic studies under National Instrument 43-101 and not considering that really under IFRS you have to update those, and those studies may not be appropriate for a life of mine discounted cash flow valuation under IFRS. I won't go into more details, but that's some of the issues we do see. In light of the current environment, one thing we will definitely look at, and usually the audit firms are pretty good at doing this, there's a big risk right now around mineral property rights and obligations because companies are running out of money. How do we know the properties are good standing? If you've got an option agreement with somebody else and they've got the license to the property and you're the optionee, and we go to the auditor, well, you may have got a confirmation from your counterpart in the option agreement that the option agreement was in good standing, but what if they haven't paid off for the underlying licenses? Or you haven't done all the work commitments? The property may not be in good standing, and we know this drives the valuation in E&E companies and development stage companies. So it's a very important financial statement assertion. So we are pushing auditors to do that, in case you're wondering why the auditors are requesting that information. Decommissioning liabilities, we often see auditors just relying on management's representations and not actually understanding the laws and regulations, and often a foreign jurisdiction in relation to decommissioning liabilities. And often management should probably go out and get a management's expert, get somebody to look at that. But even a site visit by the auditor or even management can sometimes ascertain that there are some actually decommissioning liabilities. I talked earlier about the lack of remuneration for management. So in terms of fraud risks, I think for the current environment, the fraud risk isn't so much financial statement fraud risk, like the Enrons of the world. I think it's more defalcation fraud risk. We've got people who've been in management for a while. They haven't made any money on their stock options, and there's opportunities for them to certainly have the opportunity, the incentive, and maybe the ability to rationalize taking money out of the company some other way. So we're looking to the auditors to be very, very sensitive to related party transactions, and where they are vouching expenditures, to take it actually to the paid check to make sure this person paid wasn't the VP of geology, for example. That would be pretty embarrassing if that came out. The other area is group audits. I mean, your group auditor here relies on a promoted auditor in a foreign country. Sometimes you may wonder why the auditor has to do some work around that, but the Canadian auditing standards do require the group auditor to do some work, not just take that report and throw it in the file. And we've generally found auditing in foreign jurisdictions has improved over the years, and we beat the drum on that a number of years ago. So I guess I come back to why should you care about all this, management considerations. I think you want to avoid restatements and late filings. And when I think about all these change in auditors, I think the effectiveness and efficiency of the audit could be impacted. I think your job as manager to have a good communication with the auditors, that there's good planning to avoid surprises. And if they're going to if there's memos or other information you need to prepare, it's done. And to be really sensitive to the fact that the auditors can't perform management's role. There's self-review, independence, rules around that. And the auditors have constraints. And obviously, the issue's brought to them on April 15th and the filing deadline's April 29th. It's going to be a real struggle, and they may roll up their sleeves and do it, but they shouldn't be doing that. And we'll be looking at that. And if you don't have the capability of management, consider using consultants. Overall, the firms are subject to our oversight. We're tough but fair. We're looking for a level playing field. An audit should be an audit, should be an audit. But you have to be aware of the fact that we're looking over their shoulder. So when they say we need to do this for CPAB, They're not lying. They're telling the truth. I mean, they really do need to do that. And, you know, there are firms that have suffered disciplinary action in relation to us. So I just wanted you to be aware of that. Carla Marie's talked in detail about the reporting to the Securities Commission. And when we do run into a restatement issue, I mean, we try to resolve it with the audit firm and with the reporting issuer. If we get into disagreement, I just want you to be aware of unintended consequences. Once it goes to Carla Marie, you start getting into legal and audit fees, and the process gets escalated. And we've also seen situations where then the continuous disclosure spotlight of the BCSC or other securities commissions gets shone on all the continuous disclosures. And we have at least, I think, one example, Carla Marie, where the company wasn't in compliance with 43101 and had to file a new or an updated report. And finally, with the protocol and the reporting of our significant deficiencies to the audit committee, they now have some insight into management's performance, because it's not just the auditors that resulted in this significant deficiency. It's usually a combination of management not doing something on an accounting issue and the auditors missing it, that you end up in a situation where you do have a restatement. So those are some of the things I think might be relevant to you in what we do. Obviously, it's in relation to what Carla Marie does too, and the auditors. But those are the things I would think about were I to be CFO again. So that concludes my formal presentation. I know there's going to be questions afterward, but thank you very much for your time.